Right, here we go again. Okay, tell me if this sounds familiar. You're scrolling through the news, there's a headline that says, Fed holds rates steady, markets react. And you think, okay, sounds important. Should I be doing something? What does that even mean for me? Is my savings account affected? What about my mortgage? What about my investments? And then you click on the article and it's 17 paragraphs of central banking terminology that reads like it was written specifically to make you feel stupid. So you close it and you go back to scrolling and quietly resolve to look into it later. Later never comes. I know. It's fine. That's literally why this channel exists. Today we're covering interest rates, what they actually are, who sets them, why they go up and down, and most importantly, what they actually do to your savings, your mortgage, your debt, and your investments. All of it in plain English with minimal financial jargon and maximum usefulness. Let's sort this one out once and for all. I'm Leo. Welcome back to Financially Fit Millennial, the channel where we talk about money without the waffle. If you're new here, good timing. Today's one is useful for literally everyone with a bank account, which I'm assuming includes most of you. We've got a lot to cover, so I'll crack on. Let's start at the very beginning. Okay, what actually is an interest rate? If you borrow $100 from a friend and agree to pay back $110, that $10 is interest. The rate is 10%. Simple. Now scale that up to the entire global economy and you've basically got how the financial system works. Banks borrow money and lend it out at higher rates. The difference between what they pay to borrow and what they charge to lend is essentially their business model. Now, there's one interest rate that sits above all others, the one that influences everything else. In the US, it's called the federal funds rate. In the UK, it's the bank rate. In Australia, it's the cash rate. Different names, same idea. It's the rate at which banks lend money to each other overnight, and it's set by the central bank, the Federal Reserve in the US, the Bank of England in the UK, and the Reserve Bank in Australia. When you hear the Fed cut rates or the Bank of England raised rates, this is the rate they're talking about. And because it's the baseline rate for all lending in the economy, when it moves, pretty much everything else moves with it. Your mortgage, your savings account, your credit card, your car loan, all of it. Right now, as of this week, the Fed funds rate is sitting at 3.5 to 3.75%. It's been held there after the Fed cut it 3 times in the second half of last year. Okay, so why do interest rates move up and down? What's the actual logic? Because it can look from the outside like a bunch of very serious people in suits, periodically making numbers bigger or smaller for no clear reason. There's actually a clear logic to it. Think of interest rates as the economy's thermostat. When the economy is running too hot, when inflation is rising, when everyone's spending, when prices are climbing faster than wages, the central bank turns the thermostat up, raises rates, makes borrowing more expensive, people borrow less, spend less, the economy cools down, inflation comes back under control. When the economy is running too cold, when growth is sluggish, unemployment is rising, people aren't spending, the central bank turns the thermostat down, cuts rates, makes borrowing cheaper, people borrow more, they spend more, businesses invest more, the economy warms up. The job of the central bank is basically to keep the temperature just right. Not too hot, not too cold. The Goldilocks economy, which sounds very simple until you factor in the economy is an incomprehensibly complex system influenced by geopolitics, pandemics, wars, technology, consumer psychology, and whatever's currently trending on financial Twitter, at which point it becomes considerably less simple. To give you a sense of the journey recently, between 2020 and 2022, the Fed rate was near zero, essentially free money. Then inflation spiked, hit 9% in mid-2022, a 40-year high. So the Fed raised rates aggressively from near zero to over 5% in about 18 months. The fastest rate hiking cycle in decades. Then last year, they started cutting again as inflation cooled. Now we're at 3.5 to 3.75 and holding. Let's start with the good news first, or at least the news that was good until fairly recently, savings rates. When interest rates go up, savings rates go up too. When the Fed was hiking in 2022 and 2023, high yield saving accounts went from paying basically nothing to paying 4, 5, even 5.5%, which felt almost illegal free money just for having it in the right account. The bad news is that we're now in the opposite part of the cycle. Rates have been cut, savings rates are coming down with them, which means if you're still sitting in a high yield account earning 5% because you set it up 18 months ago, it's worth checking. That rate has almost certainly been quietly reduced. Banks are much faster at lowering rates on savings than they are at raising them. It's funny how that works. The practical implication here is that the cash is becoming less attractive as a long-term home for your money, which is part of why capital keeps flowing into equities. Right, mortgages. This one is genuinely confusing and I think it trips a lot of people up, so I want to spend a bit of time on it. Most people assume that when the Fed cuts rates, mortgage rates fall. Logical assumption, unfortunately, not quite how it works. The Fed controls short-term interest rates, the overnight rate banks charge to each other. Mortgage rates, on the other hand, are mostly tied to longer-term rates, specifically the yield on the 10-year US Treasury bond, which is influenced by the Fed but not directly controlled by them. Which is why, when the Fed cut rates in late 2025, mortgage rates didn't fall proportionately. The market had already priced in the cuts before they happened, and then other factors pushed longer-term rates back up. Right now, 30-year fixed mortgage rates in the US are sitting around 6.3 to 6.4%, down from the peak of nearly 8% in late 2023, which was absolutely brutal, but still significantly higher than the sub 3% rates people were locking in during 2020 and 2021. For anyone who bought during the COVID era, low rate period, and is sitting on a 2 or 3% mortgage, you are in an incredibly fortunate position. Please do not sell your house and start afresh on a 6% mortgage unless you absolutely have to. I call that being sensibly smug about a good decision. For anyone looking to buy now, timing the mortgage rate market is about as reliable as timing the stock market. The better question is, can you afford the monthly repayment at the current rate? If yes, and property makes sense in your life, the rate is what it is. You can always refinance. Right, let's talk about debt. Specifically the kinds of debt that are absolutely walloping people right now, because these numbers are not pretty. Credit cards, average annual percentage rate in the US right now, just under 20%. 20%. The Fed has cut rates by 0.75% over the past year. The average credit card rate has barely moved, which is, and I'm trying to be diplomatic here, a bit of a liberty. Banks pass rate increases onto borrowers at lightning speed. Rate cuts, those trickle through at the pace of a particularly unhurried glacier. It's funny how that works as well. Car loans, new vehicles are running around 7% right now. The average monthly car payment in the US hit an all-time high in early 2026, $773 a month for a car. That is, if you'll permit me a moment of editorial opinion, an extraordinary amount of money to pay for something that loses value the moment you drive it out of the forecourt. If you're carrying credit card debt at 20%, paying it off is literally a 20% guaranteed return. No investment in this world reliably beats that. Pay the expensive debt first, every time. Okay, we've done savings, we've done mortgages, and debt. Now let's talk about what interest rates do to your investments, because this is where it gets a bit more interesting and also slightly more complicated. The relationship between interest rates and stock markets seems simple until you look closely. Let me give you the key principles. Principle 1, when interest rates are high, bonds and savings accounts start to look more attractive relative to stocks. If I can earn 5% guaranteed in a savings account, why would I take the risk of putting money in the stock market? So higher rates can pull money away from equity. When rates fall, stocks look more appealing by comparison. More money flows into equities, prices go up. This is part of why the stock market has been doing well recently. Lower rates make equities more attractive relative to safe assets. Principle 2, rates affect company earnings through borrowing costs. When rates are high, companies pay more to borrow money for investment and expansion. That eats into profits. When rates fall, borrowing gets cheaper, margins improve, earnings go up. Good for share prices. The companies most sensitive to this are highly indebted ones and high growth tech companies whose valuations depend heavily on projections of future earnings. When rates were near zero, you could justify almost any valuation. When rates went to 5%, those valuations looked a lot less reasonable, which is exactly what happened to tech stocks in 2022. Principle 3, bonds move in the opposite direction to interest rates. When rates go up, existing bond prices go down. When rates go down, existing bond prices go up. If you own own a bond paying 3% and new bonds are being issued at 5%, your bond is less valuable. This is why bond funds got hammered in 2022 when rates were hiked aggressively, and why they've recovered somewhat since. Right, let me tie it back to right now, because this is the stuff that actually affects the decisions you might be making this week. The Federal Reserve cut rates 3 times in the second half of last year and has held them steady in 2026. Current rate 3.5 to 3.75%. The next possible cut is being priced in for June. Not guaranteed, as inflation at 2.4% is still above the Fed's 2% target. What does this mean in practical terms? For your savings, rates have come down from their peak but are still decent. Shop around. Don't assume the account you're in is still competitive. It takes 5 minutes to switch. For mortgages, 6% is probably where you're staying for a while. Anyone waiting for rates to drop back to 2021 levels before buying is going to be waiting a very long time. The smarter question is whether the payment works at current rates. For debt, credit cards are not moving meaningfully despite Fed cut. Banks are in no rush. Make a plan to attack the expensive debt first. And for investments, the rate environment is becoming progressively more supportive of equities as rates come down. Cash and savings accounts are gradually becoming less competitive. This is one of the structural reasons markets have been performing well. Here's the thing about interest rates that nobody tells you, but that I think is actually the most important takeaway from the whole video. You cannot control interest rate. You cannot predict where they're going. You cannot time your savings account switches or your mortgage applications or your investment decisions around what the Fed is going to do next. What you can control is being on the right side of them. Being on the right side means your cash earns a competitive rate, not the default 0.1% your bank hopes you won't notice. Check your savings account right now. Being on the right side means you don't carry high interest debt a moment longer than necessary. Compound interest works for you in your investments and against you at 20% APR on your credit card simultaneously. It doesn't wait. Being on the right side means you understand that falling rates are generally good for your long-term investment, and you don't make short-term decisions with long-term money based on where rates are today. And being on the right side means the next time the headline says Fed holds rates steady, markets react, you have a rough idea of what it means for you specifically, which if you've watched this far, you now do. Well done. Interest rates, the thing that affects everything and that most people know just enough about to be vaguely stressed by headlines without actually knowing what to do about them. Now you know what the base rate is and who sets it. You know why it goes up and down. You know what it does to your savings, your mortgage, your debt, and your investments. And you know where things actually stand right now. If there's one practical thing I want you to do after watching this, go and check your savings account rate today. Not next week, just do it today. It takes 5 minutes and there's a good chance your bank has quietly reduced it while you weren't looking. That's not conspiracy, that's just how banks work. Link in the description to the calculators at financiallyfitmillennial.com. Go and have a play around and see what that does for your future. All right, legends, subscribe if you haven't, drop a comment below. What aspect of interest rates have you found most confusing? And I'll see you in the next one.